Good morning. So, are we going to have a huge housing collapse? No. And let me tell you why. And I'm going to debunk a lot of the things that all these guys in their videos are saying about what's coming and this terrible gloom and doom. It's great for their hits and their people seeing their videos. I get that it gets a lot of traction. But the reality is they're missing a lot of things in the stats that they're using, and I think they're completely off the mark. So, for those of you who don't know me, my name is Adam Kahn, and this is my half-ass channel. I'm going to start with the first one about the increase of inventory. So, at least here in Las Vegas right now, last I looked, we had about 4,700 homes on the market. And a lot of the people on YouTube are pointing to year over year, we only had about 1,000 or a little less than 1,000. Well, that was part of the reason the Fed started raising rates. Things were getting out of control and we had no inventory. There was too much demand and the prices were just going straight up because of it. Our average homes on the market is somewhere around 12,000 typically. So even though we are now 4 times higher than the 1,000 that we had a year ago, we're still only 50% of our typical inventory. And that's only about 45 to 50 days worth of inventory even on the market. On top of that, we have 2,600 homes in escrow that are expected to close. And on average, we've only been having 2,200 homes come to the market. So we're currently in a net negative of decreasing inventory again. I think it's going to be very hard to have decreasing prices if we have decreasing inventory. There might be some people underwater running into trouble, but that's a natural ebb and flow of a market. Like that's pretty standard and pretty healthy. On top of it, people also have some healthy fear now that they didn't for a little while, which I also think is a great thing. I mean, you don't want people buying $500,000, $700,000 homes just jumping into it because, oh, real estate only goes higher. It's great that people are a little bit nervous and think it through because they should have some savings. They should know that they can afford those payments. Like they should be thinking those things through and nervous that maybe it doesn't go straight up and up and up. For those of you who think that means it goes down, like what I try to look for in all markets is when things don't make sense in terms of price action and what's going on. So there's all sorts of fear, there's all sorts of things going on. And a lot of the people that are gloom and dooms keep mentioning like it doesn't make sense because the prices haven't fallen yet. Well, that's right. To me, it looks a little frothy too, but they don't seem to be falling. And there's a lot of bad news that everybody is well aware of, including these multi billion investment companies that are putting money into housing and all sorts of things. So somebody is picking up the sales and thinks that it's reasonably priced. And if anybody thinks they can predict tomorrow or the next week or month or a year down the road, I beg to say, no, you can't make that prediction. And the market today is always fair for what the market is. So we'll get to the next point, which is the affordability and interest rates and things like that. I can tell you demand has picked up wherever the interest rates are. Too high, too low. Anybody can debate whatever they want. The markets are indicating that odds are rates are going to come back down based on what the bonds are showing, not just somebody's opinion of their thoughts because they're excited or scared or happy about a market. If you look at where the inversion of the yield curve and bonds and how they work and what they predict, what the prediction is right now is the Fed and interest rates can't go too much further because things are a little bit stretched, and odds are they might have to pivot and reverse. I also agree with the dollar seems to be getting weaker, which would go in line with all of that. Everybody's talking about the strong dollar at the same time. Euro currency has gone from about par or parity or even dollar to a dollar, tiny, and I don't think it ever got quite below that, all the way back to almost $1.10, which is a 10% significant move. Well, currencies tend to trend for 10, 15, 20 years. And to be fair, I think the media got pretty excited about how strong the dollar was getting, and it's possible we could have a good long reversal of that. If the dollar gets weaker, and we have the 2 to 3% inflation the Fed's talking about, and you continue to see the price of bread or a can of soda or a car or whatever continue to go up, I don't know why you would think a house would be excluded from that equation. Everybody's comfortable that we seem to have a pivot in terms of things getting cheaper and cheaper to maybe we hit a price point or whatever it was that the cost of life may continue to go up. It's hard to imagine that the cost of everything in life is going to go up, but somehow housing is going to be excluded. There's just a disconnect there. So, in a lot of the videos I'm watching, they're talking about inflation and things getting more expensive, so people aren't going to be able to afford a home. Well, I get why you would think that, but if a loaf of bread gets more expensive, so does housing. It won't be a separate issue. You won't see this thing get more expensive and that thing get cheaper unless it's just an anomaly. So that being said, I think people just have to get used to the fact that maybe on a monthly basis a house costs more than it used to. On top of that, well, the dollar gets a little bit weaker and rates come down a little bit. I think that helps sustain the market, because what I'm seeing now is that the froth in the market seems to be out of it. Like all of the extra money that went out into the economy, I don't know too many people that just feel like, oh, I've got all this extra money like they did in 2021. Well, the froth is out, people are nervous, the selling pressure is there, and housing seems to have gotten a little pickup. And if rates continue to go lower, I don't see why that would change. When I go out to dinner or I go to Sam's Club or wherever it is, places seem to be quite busy. Now, I know that can change. I know people have been losing jobs. I know things have been going on. I understand that credit card debt is at an all time high and going up. I understand that bank accounts seem to be going lower, but people still seem to be living their lives and going out and affording things. Part of why I do these videos is I hate the idea of scaring people out and making them lifetime renters. Because do you think rents are going to go lower significantly, or do you think that rents went a little too high and similar to the housing, they've pulled back a little bit, but they seem to hit some new normal of what people get in rent? Because if rents aren't going to collapse, well, housing's not going to collapse. Again, I just hate that concept. Now, please remember, I am not a financial planner. I'm not an accountant and I'm not a lawyer. You need to use any of the information on my channel for entertainment purposes only. Please reach out to your financial planner, your accountant, or your lawyer for the financial decisions you make. I'm just sharing the information that I have and my experiences. I used to be a trader on the floor of the commodities exchange. I've traded currencies for a long time. Um, and what I notice is when there's a lot of panic, that tends to be the end on either side. Now, currencies go both directions. So that's why I say it was different than trading stocks or things like that. And what I found is when the market got overexcited going too high, it was generally overextended. And when it got too excited on the other end and people got scared and people were selling whatever it was, that was a little extreme. Doesn't make sense to me because I agree the house prices look expensive because of where they came from. Interest rates are high in comparison that they got put down way low to help the economy. So I get the disconnect. I would just hate to see people miss out on the next run because the sellers are scared. The market has come in, and you're in a position where the loans were different. The new builders were much more prepared. When I moved out here, we moved out in '05, and the new builders were just building rows of houses. You could see, workers out there putting up 10 homes at a time and all these different, like, not just 10, but in all sorts of these subdivisions. Even during the boom this time, that's part of why we didn't have the too much inventory on the market. The home builders weren't just building for the demand that was coming in to be in advance of it. They still waited for somebody to put earnest money down and actually qualify for the home. Now, of course, they have some fallout and people leave and whatever else, but way different than just putting up hundreds of homes in preparation for the demand that was coming. So we didn't overbuild this time. 2008 is not that long ago for a corporation and for a lot of us, to be fair, which is why I think the nervousness is there. Generally markets don't collapse from prices of already coming off. And when I go out and about, places look like they're doing okay. I'm sure other ones are struggling. I'm sure everybody's had to adjust to the inflation. But once they've adjusted and now understand it feels like the new normal, I don't really see what in the economy is going to make that change. At this point, it seems like the Fed is determined to try to keep things where they are and try to manage through it. Yeah, everybody's budget has gotten tighter, and some people might be doing cash out refinances, which I personally have not seen, and I do mortgages. I haven't had a whole lot of people reach out looking to do cash out refinances because they're not happy that the interest rates are higher. But maybe there are some people who are, and yes, that would be concerning if a client called me who wanted to do a cash out refinance, because I agree. Moving from a 3% interest rate to a 7 to take out cash sounds scary. If they're doing it to get rid of credit card bills or mistakes of things like that, and they really can afford the payment, I get it. But I also see the nervousness of, well, what if they're just taking it out because they can't afford their bills currently? I understand all of that. None of it to me paints a picture of a market that's collapsing. What paints a picture of a market collapsing is that gets lots of views and people are excited about it. It gets them all worked up. I see the comments of, oh, you're the only one telling the truth or this or that. I don't think it is. I think it's people misunderstanding data and not reading the markets right. It's interesting to me, the perception, especially because when I look back, do me a favor, whoever you're watching or whatever you're doing that you agree with them, look back a year ago and see what their videos are saying then. Because the ones I've watched, like, they were super bullish, and maybe if somebody did a small price reduction, they were like, oh my God, great opportunity. Now that the market's reversed a bit, it seems like the nervousness and the sky is falling type of stuff is coming out that I disagree with. To be perfectly honest, I think it's time to look and see what the opportunities are. Um, it's interesting that people have gotten used to the higher payments and are just fine with it. And I don't mean just fine, but if they have jobs, the systems in place are set up to make sure people qualify. We didn't have the loans of the past where you could just tell somebody what your income was and get into a home and a loan that would adjust that in the next 5 years. Most people have 30-year mortgages with a fixed rate. It would take a lot to scare them out of the market, and why would the home builders just build a bunch? To be perfectly honest, they're in a great position. Materials have dropped a ton. Their cost to build has dropped. They have great margins, even though labor prices have gone up. But if we start to see a little bit more unemployment, they should be able to mitigate that as well and put themselves in a wonderful position. I see the market just a lot differently than what everybody else does. And be prepared. If things do slow down a bit, the Fed may cut rates. You'll see the recession come around. Like, if they start cutting, it's because they do see a slowdown. But I think what could happen is money will be tight, the news will be scary, there might be a slowdown, but you might see equities and housing go up, especially if there's a little bit of inflation through the economy. So, anyway, maybe subscribe, like, give me a comment as to why I'm wrong. I'm happy to talk about all of it. I find it interesting and I like watching it. So, again, my name is Adam Khan, my half-ass channel. And in case I forgot, I'm not a financial planner, I'm not a lawyer, and I'm not an accountant. Use my information for entertainment purposes only and reach out to your financial planner, your accountant, or your lawyer for the financial decisions you make. Have a great day. Oh, and I try to go straight through on my videos. I try not to hit stop or edit or pause so that you guys can just have a conversation and see what I talk about. I love markets. I have a pretty good feel for them, I'd like to think. Been watching them since I was like 10. Uh, Weird that that's what I was into when other kids were into other things. I just always found it fascinating. Have a great Sunday.